from the you can say from the company funds. It also includes the deposits. It also includes the loans which has been given by the promoters or the directors for their own usage, or the case may be, and that is all about the internal sources. Sometimes the promoters or the directors may also raise the personal loans so that they can do their own investment in the life insurance policy, the investment, you can see funds or the provident funds or any other fixed assets or any other related form of the investments. And if the business is actually long running or it's actually upgrading and expanding for a long terms, then the entrepreneur will always keep a part of the profits or plugging back from the investment so that they can expand their businesses. And that is also a part of the internal sources. When any promoters or directors raise the personal loans on their investments or provident funds or any other forms of investment, so whatever the profit they earn from these investment, that is also a part that they can use for the expansion of their own enterprises, and that is also the one of the source, or as we can see, as an internal source of the, you can say, finance. So the profits that the particular promoter or the directors earned from these investments, that actually called the retained earnings. So retained earnings may not be a very huge amount for the small enterprises, but actually it also forms as an internal sources for its own enterprises when they rise any personal loans on the following, on the other or the followed forms of the investments. Now we can talk about the next sources, that is called the external sources. So the external sources include all other sources which are external, which are not internal, or which are related to the outside the enterprises or external. That is called the external sources. And the external sources of funds may be further divided into two parts. That is the debt financing and the equity financing. That financing, when the particular promoters or the entrepreneurs actually take the loans or the funds from the banks or the financial institutions in return to pay an interest over a period of time, that is called the debt financing. And equity financing means when any of the promoters or entrepreneurs or the directors were willing to sell their shares so that to expand their businesses, and that is, or to use that funds by selling up their shares for the upgradation of its own businesses, and that is actually called the equity financing. So debt financing is always include the borrowings or the lending from the banks or the financial institutions so that they can meet up the short-term requirements or the long-term requirements. So when we talk about the short-term requirements, we always talk about the working capital requirements, and when we talk about the long-term requirements, we always talk about the term loans, where they can take the loans over a period of time, whether a short period or the long period, to meet up their own enterprises requirements or the outside requirements or outside the business requirements as well. It also includes the issue of debentures or any kind of bonds, etc. But while we can talk about the angel investments, venture capital investments, mutual capital investments, private public offerings of the shares, private equity, it always a part of the equity financing because it deals with the sales of the any other sort of investment, sort of shares or bonds, so that they can use that money or save that money for a future investments, and that is exactly called an equity financing. And these are all the part of the equity financing, whether it's related to angel investments, the investments which always do for a long period of time, venture capital investments, private offerings, etc. Now we can talk about the one of the most important topic, that is called the capital structure. So this particular term is the most crucial or the complex component while starting up a business, and that is exactly called capital. So it acts as a foundation of the company, a root of the company, and where the debt and equity are the most important primary types of the capital sources for the exact businesses. So capital structure is defined as a combination of equity and debt, which always together for the put together in use by the company in order to finance the overall activities or the operations of the company, and of course to expand their businesses for its own growth and development. And that is exactly called the capital structure. So we already talk about in normal sense that the capital structure is also refers as the arrangement of the capital by using up you can see different sources of the funds, which are always divided into two main parts, that is equity and the debt. And these different types of the funds which are always raised by the companies or the firms, that could be preference shares or the equity shares or the retained earnings or the long-term loans, etc. And that this is a way that how the capital could be raised by the companies or the firms, and that is exactly called the capital structure. Now we can talk about the types of capital structure. There are two main types, that is equity capital and the debt capital. When we talk about equity capital, the equity capital is the money which is always held or owned by the shareholders of the companies or the owners of the company. And that's why it consists of two different types, and that is called the retained earnings and the contributed capital. When we talk about the retained earnings, is always a part of the profit which always kept separately by the organization, so that they can such funds which always helps to for the growth of the company, for the expansion of the businesses. The next one is the contributed capital. Contributed capital is that amount of money which the company owners which always invest when there is a time to opening or the startup of the company, or any amount of money that has been received from the shareholder as a price termed by the for the ownership of the company, and that is called the contributed capital. Next, we can talk about the next category of the capital structure, that is called debt capital. So debt capital is always talk about the lending of money or borrowed money that will be utilized for the businesses. And of course, it always categorized into two main parts, that is called the long-term bonds or the short-term commercial papers. When we talk about the long-term bond, these type of bonds a promise that we have to pay the certain sort of money or interest over a period of time by on the amount of loan that has been taken from the bank or the financial institutions for a long period of time until it's not mature. So that's called the long-term bond. So these type of bonds are considered as the safest type of the debts, because after all it has been extended period to repay that particular amount with along with the interest over a long period of time, and that time period could be year, could be extended as well. So only the interest need to be repaid, and the principal amount it always paid at the maturity date. Next, we talk about the short-term commercial bank. This is also one of the type of the short-term debt instruments, which is always being used by the company so that they can rise, they can increase the capital for a short-term period. Now we can talk about the most important point, that is called the optimal capital structure. When we talk about the optimal capital structure, it always a perfect mix of the debt and equity financing. And we can, in the words, we can call it's a combination of the debt and equity, which always helps to maximize the value of a company, or in other words, we can see the market value of the company, so that it could minimize the cost of capital or cost of, you can see, a debt more into the company. So capital structure is always depends upon industry to industry. So for a company like which the company which always involved in mining and petroleum or the oil extraction, it always a high debt ratio is always not suitable for exactly those industries who are mainly involved in petroleum mining and oil extension, and where the high rate of the debt ratio which never be suitable for such industry. But some industries who are belong to the service sectors like insurance and banking, where the high debt ratio is always a part of the capital structure, which could be called an optimal capital structure, as after all, the particular debt amount could be recovered from these services sectors. Next, we can talk about the financial leverage. The financial leverage is always a proportion of debt. It's that proportion of the debt which always a part of the total capital of the firm, and that is called the financial leverage. In other words, we can also call the capital gearing. So where the firm who are having a high level of debt, we always call such firm a high leveraged firm, while the firm who are having a low debt ratio, which we always call such firms a low leveraged firm, where the ratio of debt could be low for a low leveraged firms, and the high leveraged firms, which always includes the high debt ratio. So it also, so the names could be called and could be called to them, and after knowing the debt ratio or the debt equity ratios, to say it very well that whether it would be the high leveraged firm or a low leveraged firm. So it totally depends upon the debt ratio. Now we can talk about the next section, that is the factors which determining the capital structure. The first one is the risk of cash insolvency. So the risk of cash insolvencies always occurs when a company or when the entrepreneur cannot be able to pay up the fixed interest liability. So that it always involves a high proportion of the debt in the capital structure, and that particular case, the company has to pay the higher rate of interest on the debt that they have taken from the banks and the financial institutions. So the interest which is not being paid yet, that actually charge a lot, and the principal amount would be doubled, and there is a time comes when the company goes into a liquidation. So when there is a time for the banks or the financial institutions to take up the funds or the debts that the company has taken from them, that actually arises a situation of the cash insolvency, where the company or the entrepreneur is not able to pay up the exact amount, principal amount, along with the interest rate. And such risk of cash insolvency is always occurred, which always determine the capital structure of the company, and it could be avoided if any of the project is financed by issuing of equity shares. Next, we talk about the risk in variation of earnings. So when any entrepreneur or the company were having a higher debt ratio, then automatically there could be a higher risk in their earnings, in their total amount of the earnings. So if any return received on any of the investment that actually exceeds the interest rate, then it automatically we can always say that the investors achieve the higher rate of return. So if any of the interest rate exceeds the return received on investment, and actually the shareholders may not get any returns at all. So it totally depends upon the interest rate, because after all the earnings could be decided after neglecting or after paying up the interest amount on the debt. Next, we can talk about the cost of capital. The cost of capital is always means and how the company could rise the cost of capital from different sources of funds. It could be equity shares, it could be the preference shares, it could be the bonds. So any price which is paid for using the capital, that is exactly called the cost of capital. So any business can easily generate the enough revenues so that they can meet up their cost of capital and the finance or the investment opportunities for its future growth. So finance manager has a responsibility to consider or to decide the cost of shares, the cost of equity shares, or to look after the various source of funds so that they can rise, you can say, their share capital of the businesses while designing the capital structure of the company. Where is a combination how the finance manager can have a perfect mix of the equity and the debt. Now we can talk about the controls. So we the consideration or the main factor which determine the capital structure decision is how the business could retain the control over the operations of the companies. So if the existing equity shareholders does not like that there should be over control, so they would prefer a debt capital to equity capital. So they can move over the debt to equity capital. So that means the existing shareholders may not have any voting rights if they convert or move forward from debt to equity capital. Next, we talk about the trading on equity. So the use of fixed assets where that has been put on the various types of the securities like shares and debentures. So along with using up the other sources of funds, and that is called the trading on equity. So where there is a use of the fixed interest along with the using up the external or other sources of finances, and that's called the trading on equity, where the investors is always keen to invest on different sources of different investments, knowing this fact that there is a fixed interest rate on such security that the investor has to bear up. So it is an arrangement by which the company is always aims to increase the return on equity shares or debentures or preference shares, having up the fixed interest rate on such securities. So if the existing capital structure of the company, which always consists mainly of the equity shares, then the return of such equity shares could be increased by using up the debt ratio. And that is exactly called a trading on equity, when capital structure of the company could be decide if any of the investment done or using up the various sources of finance, then the return of such securities could be increased if any investors of the company is using up the borrowed capital or the debt financing or debt capital. Now we can talk about the next factor, that is called the government policies. So capital structure is always influenced or affected by the government policies or the rules or regulations of the Security Exchange Board of India and the lending policies of the financial institutions, which always change the pattern of the company totally in terms of financial. So, under these policies, the monetary and the fiscal policies of the government, which also affect the capital structure decisions, because after all, the fiscal and monetary policies will always change time to time, and automatically such policies which always affects the capital structure decisions of the company time to time. Flexibility. So the capital structure of the company should be such that whenever the company rise the funds and whenever it's required, so it is very easy and flexible for the company to do or to take such decisions that how the whenever they want to raise the funds from the various sources of finance. So flexibility, which always provides room for the expansion, for the growth, and even both in both aspects, whether it could be the lower impact of the cost or there would be a no significant rise in the risk as well. Next one is the period of finance, the period for which the finance is always needed and influences the capital structure. So the funds could be the long term, say a 10 years or 15 years, where the company could raise the capital by issuing the shares or the you can say the debentures, and the funds could be raised by issue of the equity shares whenever it's needed permanently. But it totally depends upon the period, that on what period they are actually issuing the equity shares to the investors. Next one is the nature of business. So it has a great influence of the capital structure of the businesses, as the companies who are having a stable growth, they always prefer debentures or preference shares, and the company who have no assured income, it totally depends upon the internal sources for its own expansion. So so it is very easy to understand the companies who are actually having a lot of earnings, they prefer debentures or shares, whatever it possible could be. And the company who doesn't have any assured income, it totally depends on the internal resources of the company so that they can use that funds, they can use that internal sources to for the expansion of its own businesses. Next one is legal requirements. So the finance manager is always follow and obey the legal provisions while designing the capital structure of the company. And the last four are the purpose of financing. There is a significant decisions or the purpose should be you can see considered in the form of financing, because after all the capital structure of the company is also affected by the purpose of financing. So if the funds are required for the manufacturing purposes or the manufacturing activities, then ultimately it always issue the shares or issue any sort of debentures for long-term purposes. When the funds are required for the non-manufacturing purposes, like for the welfare activities to workers and the like schools, hospital, education, the company will always procure from its internal sources. So automatically the financing is totally depends upon the types of financing, whether it could be the long-term or the short-term financing. Next one is the cash inflow. The selection of the capital structure is always affected by its own capacity of the business, that how they will generate the cash inflows and outflows of the company. And ultimately, when we talk about the to estimate the cash inflows and outflows, or to generate the cash inflows, it always analyze the solvency position, the ability of the company to meet up their expenses. Next one is the provision for future. The provision for future requirement of the company is totally being considered while planning up the capital structure of the company. It means while any analyst will planning the capital structure of the company, it always meet up the provisions you can say for future requirements of the capital as well. The next one is earning before interest in capital and earning per share analysis. So if the level of earning before interest and taxation is low from the earnings per share point of view, that means equity is more preferable for to debt. If the earnings before interest and taxation is high from the EPS point of view, then the debt financing is preferable to equity. So automatically when EBIT is low, then equity will be preferred. When EBIT is high, then debt financing is preferable. So automatically the interest rate always plays a very significant role in this particular type of analysis. So if the rate of interest is less than the rate of interest is less than the rate of interest on debt, then the debt financing decreases the return of earnings. So automatically it always, the rate of interest on equity is less than the rate of interest on debt, then the debt financing is preferable, or it decreases the return of earnings. If the rate of interest on equity is more than the rate of interest on debt, then automatically the debt financing increasing the return earnings. So that is the exit analysis. It totally depends upon the level of EBIT and the rate of interest, which is more than and less than the interest on debt. Now we can talk about the most important part of this section, that is the stages of the business development and the source of funding. So there are around 5 stages. The first stage of any business called a pre-seed funding stage, where the entrepreneurs have an idea, they just where the funding is needed to check the feasibility of the idea, and accordingly they will conduct the market research on it. But there is a fact that there is no customer base at all to be needed for such market research. So the second stage, once the idea seems feasible through the market research, then the entrepreneur or the businesses entrepreneurs move to the next stage, and that stage is called the startup stage. So here we can, entrepreneur will look into the designing that what would be the information needed to describe or to give a description of the product and services, and where the entrepreneur start working about the description of the product so that it would get ready within a short period of time. So it totally depends upon the findings, upon the market research, the pilot study, the feedback of the particular internal sources, and accordingly the changes is to be made in the product and the services concept, not in designing the product or in making the product. No, in the startup stage, here we are the particular entrepreneur is always think about it, how it gives a description of the product and services. And in this stage, the entrepreneur is always keen to give a description of the product or to get the description of the services ready. Next stage is seed and the startup stage, both the preliminary and the venture. In this particular stage, the preliminary, the pre-seed stage and the venture development stage would always involved in this. It's a combination of the seed and the startup stage. Here in this particular stage, the businesses which always rely on funding, the funding which is called a personal savings, they can, entrepreneurs, they can borrow the money from their family or the friends, and that stage is called seed and the startup stage, where they can start arranging the funds, you can say, from the personal savings, from the family and friends, etc. So of course the entrepreneurs also think about whether is there any government grants at this stage available or not. And these days the entrepreneurs will always approach the angel investments or the crowding fundings, you can say platforms. These particular investors or the platforms, which always gives an opportunity for the entrepreneurs to give to provide them a funds for a short-term period, so that ultimately they would get a returns, a rate of returns on it. And these investors in crowd funding platforms, which always helps the entrepreneurs to fund the business needs at this stage, so that they can cover up the needs of the particular entrepreneurs for the particular businesses. In the next stage, when they will thought about the fundings, they have searched out the angel investors and the venture capital, you can say, or the crowdfunding platforms, where so that they will get an idea that who will go into funds for to meet up their business needs. Then the next stage comes that customer base is now ready. The entrepreneur wants to expand its business with the new products and services. They will expand their customer base and management team. And that's this stage. The next stage is called the expansion stage, where the angel investors and the venture capital investors will always helps the entrepreneurs to raise their funds and expand their businesses through a series of funding. And once the startup is matured and it reached to the advanced stage, it will think to rising up the debt capital from the banks or the financial institution. Because in the initial stage, no bank or financial institution will give the funds to these entrepreneurs. So they will approach the crowding funding platforms or the angel investors or the venture capital investors, who always helps the entrepreneurs to meet up their business needs at the early stage. And that's why these investors which always come forward to help them. In the last stage, when the startup wants to grow further and they involved to diversified platforms, there is also an option to offer shares to the public good, which always called an IPO. Again, the company entrepreneurs will always opt a private equity shares, where they can offer the equity shares to their shareholders only. Private placement as well could be considered. So this is the last stage of startup funding stages. So where they can raise the capital and so that the funds could be arranged for the future growth. Now, one of the most important topic in this particular section, that is a bootstrapping techniques. So what is exactly the bootstrapping techniques? The bootstrapping techniques will always work on a one of the most important principle, which is called as a penny saved is penny earned. So whatever the penny that you have saved, you can earn from that savings. So these techniques is a collection of methods that how you will maximize your profits, your earnings from those savings that you have saved since so far, to minimize the risk or to minimize the need for opting out and also outside financing for a startup a business. So every successful company will always apply this particular technique in the initial stage of their venture development, of their business development, where they were looking out the options of funding like crowdfunding platforms or angel investors and venture capital investors. So at this stage where the investors are not willing to risk their money is a good option, because after all it is a riskier, you can say, decisions to take up funds from the these investors and use up, you can say, for the growth, rather than the business has an equal which will always get a chance to use or to increase the revenue by using up their own savings. So this techniques is always, you can say, a good option for all those entrepreneurs, that how they will expand their ventures, how they will use their own savings to sustain their mode of businesses. And these techniques is always you can say bring a discipline that how they will handle the cash outflow. So let's take in a follow-up examples of this particular technique. So it's this particular concept that buying, instead of buying up or investing on a new machines, let's buy a used equipment, renting the physical space instead of buying the land and buildings, working from home to save upon the infrastructure cost. And that's why it's called a penny saved is a penny earned. So whatever you have saved, you can utilize that and expand your businesses for your saving, and automatically you can earn from that savings only, and that is called the bootstrapping techniques. Availing discounts from the suppliers, use of the credit cards to pay for expenses, and earning credit times for delaying the payments. Partnership instead of employing to save over the on the salary. Easy loan from family and friends without paying any interest cost. Sharing of equipment, employees, and office space for cost saving. Here we can talk about the workspace. There are new platforms where the new and small entrepreneurs, or the you can say large entrepreneurs, just hire for a month, hire an office or hire a cabin for a month, and that's called the sharing of the office space is also leads to the cost savings. Employing the relatives and friends at below market salaries, that's true. Obtain advance payment from the customers. So this is how these are the example of boots strapping techniques, where it always portray that how to save the money so that they can earn more and more into it. Advantages. So, since the entrepreneurs do not raise any equity or debt or involve any such concept of perfect mix of the debt and equity, then automatically it leads to bootstrapping their ventures. So, it's a complete freedom to take over the loan from their family and friends to implement their own strategies. There is no interference of the investors in the operations of the businesses, because after all they are borrowing from their family, friends, or relatives, or they're using their own savings. So they have full freedom to operate their own business by own self. They can retain the complete ownership of the businesses, as there is no involvement of the external investors. So automatically the businesses who are actually, and with no support of the investors, that businesses could achieve and accomplish the objectives of its own businesses. Next, we talk about the limitation. If and too much bothered about the too much use of bot strapping techniques, it could be risky, because automatically it totally depends upon the liquidity crunch. Sometimes it limits the funds of the startup, or to scaling up that businesses, or reaching up its full potential without any support of the investors. So depending on too much on such techniques could be risky. So the second limitation, the entrepreneurs is always might be a multitasking. Sometimes it could be stressful and time consuming as well. The entrepreneurs might have to work, you can say, unlimited time to keep up the records of the cash inflows, and needs more organized and systematic way, which is sometimes the you can say entrepreneur could not able to do up while engaged into other activities of the businesses. The risk of failure could be higher, depend too much depending upon the you can say bootstrapped businesses or using of the techniques, because entrepreneur is bearing up the entire risk without sharing up with any other investors, because they are not taking up the money from the investors like angel investors or venture capital investors. They actually using their own money, and the risk of failure could be more if the too much dependency on such techniques. Now we can come up to the next section, which called the angel investors. What are the angel investors called for? Angel investors called a seed investors, which are quite high, having a high net worth individuals who always invest for a long term entrepreneur projects or businesses, and in return for equity shares more and more in the companies at the initial stages of their business development. And that is exactly called the angel investors. So angel investors are those individuals who always look upon the promising, you can say, projects, or you can say businesses, so that in return they will get more and more equity shares in the company at their initial stages of business development, and that is actually called the angel investors. The angel investment is also known as an informal risk capital, because the investment approach is not very professional or formal as compared to the venture capital investors. Because in case of the angel, the professional way of investment is not possible as compared to the venture, where the rules and regulation has to be obeyed to do an investment for the businesses. And that's why this terms is actually originated with the funding of the Broadway plays in the early 1920s and 30s, so that they were getting the production of the ground. So they work, you can say, huge hard, which is not professional, but ultimately they are just looking up the opportunities and the promising projects, as we can see for the entertainment industries. So the movies who have a very good content, and the producers will always come and look for the promising scripts and the direction. They always invest money, and that's investment. This is not a professional, but it's doing promising projects, entrepreneurs projects, or the entertainment projects, and they do that investment. So such investors are called the angel investors as well. Features of the angel investors. So, as traditional investors, angel investors invest in the unconventional and the highly risky investments. You can see in the industry, entertainment industries, where the producers invest 100 crores in making up a money, and ultimately they have a full confidence and believe that this movie would get success, but ultimately it was in a downfall. So it's a risky investment. It's a very risky investments when we talk about the angel investments. Angel investments will always bridge a gap between the early founders, friends, and family financing and the later institutional financing. So it always bridges a gap. It always maintain the gap between two of them. That how the differences of between is always occurs between the financing from friends and families and the institutional financing as well. Many angel investors are entrepreneurs themselves. They are actually the corporate leaders and business professional, and they have a very good knowledge of the good technology and the businesses activities. Angel investors does not only provide the capital, but they always support as a investee in a non-financial way. They will coach and mentor the portfolios companies so that they can lift up the healthy and stable growth. So they can also introduce the entrepreneurs to potential customers and suppliers and investors as well. And they always provide a solution whenever there is a problem, whenever there is an issue arises in the startup, the farms, or how they will build up the credibility in the market. Next feature is they mostly invest locally. So because they believe in hands-on approach, they regularly visit the investees, they involved in their strategic decisions of the companies, and that's why they could do much and much better if they invest locally. They are informal investors. Their decisions is always done through a startup of the companies, and it could be done through the references as well, which call a referral. When any of the startup is referred by the past investees or friends or relative or any of the consultant, so it's very easier for the angel investors to do an investor through the referred invest enterprises or the companies. Reasons for the angel investments. So angel investments are the entrepreneurs as them. So the whatever the problems we face, they can solve immediately. Sometimes angel investors want the support of the entrepreneurs from their, you can say, home ground or the native place as well. Angel investors have an entrepreneur spirit and always moved by a bunch of innovations and creativity because they always want to investments in a promising projects which always work on the innovations and the creativity. So by investing on new business ideas, they always stay connected with the new inventions, innovations, which wherever it's involved in. Angel investors are the successful entrepreneurs because they are, after all, the business leaders, and society has given enough name to such investors because, after all, they have a wealth to them. So they feel now it's time to get back for such investors while start up any particular company. So beyond all these reasons, it is very important to understand the need of the angel investment or the angel investors when you have a new or unique business idea which always contribute your personal skills and the contacts to the entrepreneurs. Now, angel investment networks in India, and of course, the formal association of angel investment is available all over India, where on for those entrepreneurs who are actually dealing or deal with the startup stage. So these networks are basically connected all those entrepreneurs with their interested investors. So there are many networks since in India, like the Indian Angel Network, Chennai Network, Rajasthan Network, Hyderabad Network, Chandigarh, Bangalore, Bombay Network, and so on. So all these networks have different objectives and they are just governing structures regarding what would be the source of investments that they deal with, how they will evaluate them, how they will involve with the investee, and how they will excite it from the portfolio's company. So that is, and these particular networks, which always helps the young entrepreneurs and how they will deal with the investments during the startup stage. Angel investment scenario in India. According to the Indian Venture Capital Report 2021, India is one of the most leading startups hubs globally, where the lot of Indians who are coming forward to start up their entrepreneur businesses or start their business being as an entrepreneur, and that's the main reason, according to this report, that India is one of the leading startup hubs globally. So in that, this development is reflected in the growth of the angel investments in Indian startup. And the report shows that the investment by angel investors increased 24% to 341 deals in 2000 from 275 in 2019. So automatically this is a huge numbers where we can say the investment by the angel investors is being increased. Now we can come up to the next section that is called the venture capital investors. So the venture capital investors are also equity investors, as we can, it's similar to the angel investors as well. They also involve high risk, high reward business ideas. as traditional investors always prefer to invest when they've proved and have a proven technologies, but the venture capital is always eager to fund the projects where entrepreneurs are explored something new or having an unexplored areas. So the venture capital funding is rise to scale up the existing operations so that they can develop their new products and services within the business premises. And the venture capital also is a formal risk capital, as venture capital is very much professionals and formals as compared to the angel investors, as angel investors are informal investors. Venture capital invest as early expansion and expansion stage for equity for the funds in the venture. So they shares equal ownership. They shares ownership with the promoters as their active investors and provide hands-on approach to the management as well. History: the concept of the venture capital originated in 1946 when the journal Doritus set up the American Research and Development Fund in the Massachusetts Institute of Technology. So this man is also called a father of the concept of the venture capital. But in India, the government issued a set of guidelines for the venture capital industry in 1988, and the culture of such venture capitalization began during the period of the liberalization in India. So the venture capital industry in India is regulated by the Security Exchange Board of India, and the Indian Venture Capital Association is an apex body and is set up by the leading industry professionals in India. So the main purpose of the Indian Venture Capital Association is to promote as much the private equity and the venture capital industry in India. Structure of venture capital fund. So venture capital invest in the ventures through a funds only. So when they have a funds, they got into a partnership and they become the journal partners, and then they start investing their projects. So the investors will provide money to set up the funds known as the limited partners, and they will turn as the partners because after all they are investing their money on the new projects. So the insurance companies or the university endowment and the pension fund, they can serve as a limited partner. So the limited partners provide funds, which is called the passive investors. So the journal investors are also termed as an active investors. They assist, they advise, they concern the portfolios companies, and the journal partners will usually get 20% of the capital gain earned from making a venture capital investment, while remaining 80% will be used for the contribution in the further funds. Journal partners always get annual management fees up to 2% of the capital investment, and the journal partners accountable for the performances or to look up the performances of the portfolio companies, which is very stricter and due to the due diligence, rules and regulations, etc. Let's talk about the features of the venture capital investors. So investment. So venture capital is a high risk, is a very professional, unconventional ventures. So it is very different from the traditional finance, as like traditional finance is lacking of collateral, uncertainty about earnings, but the ventures which always raise capital from the capital market at the initial stage. Venture capital invest funds in the company for the long-term period only, so it could be 2 to 10 years. It is a defined exist rules and regulation where a time frame is to be mentioned, and when they sell their equity shares to other investors, corporate and public, so they could exist from the portfolio company. Venture capital not only provide funds, but they always take an active participation in the management of the team or the management team of the firms. They also work along with the founders, their system, and how to run and grow the company. Venture capital actively involved and assist the investing companies as well. So the valuation of such companies grows in future. So when they sell the equity shares, they realize that a high return would comes in their own way or in the form of the capital gains. Venture capital investment Indian scenario, as the startup trend is always rising in India and the support ecosystem is also developing due to the financial banks, angel investors, venture capital investors, etc. So there is a substantial growth of venture capital investment in terms of value as well as the number of deals. So in year 2021, the number of deals is doubled from 1106 in 2020 to 2067 in 2021, and it's reflecting a growth of 87%. So contribution of deal value is always observed around 12% during the growth periods. So when we talk about the angel investment scenario, it's 24% increased due to the growth in the deals. But when we talk about the venture capital investment, the number of deals is also doubled in numbers. That is 1106 to 2067 in their respective compared years from 2020 to 21. And the contribution of the deal value is around 12% during its growth period. And it could be interpreted in that compared to the deal size, the number of deals has been increased consistently. Now we can look upon the differences between the venture capital and the angel investors. That means the venture capital investors and the angel investors. Investment size and stage. The investment of the venture capital is around $1 million to $100 million. That is in billions in rupees at later stage Series A and beyond. So when we talk about angel investors, the smaller amounts as $25 to $1 lakh, that is in crores at the earliest stage. It's seeds or pre-seed stage of the funding. Funding's next aspect is funding sources and screening process. Institutional funds from the limited partners like pension funds, insurance endowments, with the rigorous and the diligence and formal agreements, then they will get the funds from the limited partners. But angel investors, personal funds from the individual investors with no formal evaluation or negotiation. But in venture capital, formal evaluation, negotiation is more. Equity stake and post investment role, higher percentage with more control and influence our strategic decisions of the company, around 20% to 50%, but lower percentage in case of angel investment, that is 5% to 25%, with a less involvement and interference in the daily operations of the businesses. That means the venture capital investors, which always plays an active role in the daily operations of the businesses, because after all the investment is more in case of venture capital investors. Investment criteria and approach to risk, focus on scalable and the proven business models with clear exit strategies like initial public offer or acquisition of the company. But in case of angel investors, it's always willing to invest in innovation and untested ideas with the long-term objectives or horizon. So that is all about the differences between the angel and the venture capital investors. Now we can come up to the term loans. So that the next section is term loan. As the name suggests, term loan is a loan for a particular time period. This could be a short term and a long term loan. Short term, it could be 1 year, long term, it could be more than a year. Short term bank loans are availed so that businesses can meet up their day to day working capital requirements of any firm. But normally, term loan is also refers to the long term loans which can be ranged from 5 to 10 or 15 years or 20 years. It depends upon the term or the nature of the project. Features of the term loan. The purpose of raising the term loan, it could be used for the expansion, for the diversified activities, for the innovation, for the modernization, that replacing the old machine or the renovation of the businesses, etc. Currency. Term loan can be availed in Indian rupees as well as the foreign currencies. And foreign currencies term loan can be availed for the import of machinery, technical know-how requirements, etc. Security. Term loans are always secure because the assets which are financed through the term loan, it's become the primary security against the loan, that you have to give a guarantor security to get the term loan. Other assets or guarantee could always be to get a term loans for a long period. Repayment. So term loans are to be repaid along with the interest. So with the banks or the financial institution, which always conduct a credit assessment before gaining the term loans. As if you talk about the bank, so the bank will always evaluate and give an assessment tool for evaluate the individual credit worthiness of the to get the term loan. So same way for the companies as well. The institutions or banks will you can say do or conduct a credit investment before they will provide a term loan to them, or the interest rate will be charged according to the credit risk. As the loan is repaid every year, the interest burden will decrease and the principal repayment a component will remain constant, and term loans could be repaid in quarterly or semi-annual installments only. Next one is moratorium period. Some banks or the financial institution will always grant such periods to the enterprises. Restricted covenants. Some banks or financial institution put such restrictions and rule regulation on the borrowers so that they can protect themselves from the default or any credit risk of the borrowers. That's it for today. Thank you so much for listening this lecture. I will come up to the more and more interesting topics, and namaste to all.